Welcome back. My name is Kyla P. Barnes. I am your financial chef and coach with Ingles Art and Finance. My website is www.onegingles.com. I am here, and these messages are recorded in one take. So if you hear me stumble over words or mispronounce things, give me a little bit of grace. I'm only trying to help. Also, I am here to make sure that your trading is insightful and directional. So, today I'm going to be covering the impact of war on the stock market. Currently, we are engaged in Trump's war with Iran, and the war has been raging on for most of the month of March 2026. Just because the markets are down, and they are currently down at this current time, they're actually down on the year. The markets have been struggling much of the 2026 year with many of the things that Trump has been proposing, as well as now we have the war on deck. A few things to note about wars is that historical data does show many of the geopolitical things that happen domestically as well as internationally only happen for a certain amount of time. Usually, defense and energy stocks will tend to perform better during times of stress. Usually, gold and silver also perform pretty well during times of stress, but nothing always works as it should given the market environment. So when we look at the market so far on a month-to-date basis, as I change my chart here, I can see that the S&P energy sector is the highest on a 1-month basis, up more than 5%. The utility sector is up more than 4% on a month basis. There are no other sectors that are positive at this time. On a year-to-date basis, starting from the calendar start of 2026, we have the energy sector up 26.49%. There is no other sector that is close to that number. Trailing behind is consumer staples, up 9%, and the S&P industrials, which are up 9.06%. What do you do with this information? Good question. That information has you reevaluate how your current portfolio is invested. If it's not in any of those items I mentioned or those sectors, it's very likely that you're seeing negative headwinds in your portfolio. The war that's going on with Iran has been going on for much of the month of March, but there have been other wars historically that have also raged on, usually sometime within the middle, the top, or the bottom of the year. If we go back and look at the war with Russia and Ukraine, which was somewhere around the 2022 year, we can definitely see there was some attrition in the stock markets, and then the stock market rebalanced. If we go back to the Great Resignation, we can see that the market pulled back. It took a few months, and then the market kept going. If we go back to the 2007, 2008 market, we can see that it fell for most of the year, and then it recouped in the 2029 year. Also, the war with that's been going on with Israel has had some cliffs and some droughts in the market, but ultimately it did repair itself. So what am I leading with? I'm leading with the fact that stock market volatility is inherent. There's nothing that we can do about the volatility that occurs in the stock market. There's also not much we could do in the way of avoiding calamity, because it always happens on some level, whether that is volatility or death, whether that is a deficit, the government shutdown, and the list keeps going and on and on. The strategy here, when we're dealing with war and when we are dealing with high tension that is impacting the market, is to stay calm. It is to have a risk assessment of your portfolio. Do you have too much of your portfolio in the market? This is also a very good time to reevaluate how much of your portfolio needs to be sitting on the sidelines. Not every session and season of the market should you be 100% in the market. Some needs to be sitting in fixed income. Some needs to be sitting in a money market that's paying a competitive rate. Some needs to be sitting in a certificate of deposit. And some also needs to be sitting in some staple stocks that have paid really, really good dividends along the way. As I was charting earlier this month, I did see that, let's see here, we got T. Rowe Price coming up with dividends, got some NASDAQ dividends coming up, as well as Altria has some dividends coming up. And then I think maybe there's some dividends related to the treasury securities. I want to say EDV or VGLT. Check those out and let me know. This message is off my dome. So if some of those symbols don't pay a dividend this month, definitely look out to when the next dividend will be. But you want to have a strategy for your portfolio. You want to make sure you don't have too much risk on the table. If you're losing sleep at night, that's not the way to go. If your portfolio is not defensively designed either on a cyclical basis, a sector rotation basis, or the economic business cycle, that gives you a good bit of time to do an about face. And that's because the markets don't always move in tandem. There's some times in which they move out of sync. Other times when the market should be performing on a sector basis, they're not. When the market should be performing on a cyclical basis, they're not. So being in tune with the positions that you're looking at and how they are performing will actually give you a winning result. The other thing that I would have you do is to build a stock list that consist of investments you would really, really like to put your money into, investments that maybe you've never really considered purchasing because they were too high. This is a good time to leg into the position, go slow, buy one share, buy two shares if it's down, and if it looks like maybe perhaps it's going to pop back up, because that's going to be your entry into an amazing result. My name is Kyla P. Barnes. I am your financial chef and coach with Ingles Art and Finance. Look me up online at www.onegingles.com or visit me on Instagram or Facebook. I will see you on the trading floor.